There's a market so massive, so dangerously invisible, that most Americans don't even know it exists. A market worth more than the GDP of every country on Earth, multiplied by 10. It doesn't trade stocks. It doesn't trade crypto. It trades riskier mortgage rate, your bank's survival, your government's debt. And here's the terrifying part. If even one tiny piece of this system fails, the entire U.S. economy could evaporate in minutes, not hours. No warning, no countdown, just a silent detonation inside the financial system that pulls everything banks, pensions, homes straight into freefall. Wall Street calls it the derivatives market, but insiders have a darker name for it. The $900 trillion shadow market, the place where the real financial power lives, hidden, unregulated, untouchable, and the most dangerous part, this market has started cracking. Most people think the financial system is built on stocks, bonds, and the banking system they see on the news. But that's just the surface. Beneath it lies a far larger, far darker layer that operates out of sight, an underground web of private deals, hidden contracts, and financial bets so complex that even the traders involved admit they don't fully understand them. This is the shadow market, and its core is a single word: derivatives. A derivative isn't a real asset. It's a bet on an asset. A contract that says, if interest rates go up, you pay me. If they go down, I pay you. It sounds small, almost harmless. But multiply that simple contract by tens of millions: banks betting on interest rates, hedge funds betting on currencies, corporations betting on oil prices. Suddenly you have a financial universe made entirely of promises, not dollars, not gold, promises. And here's what makes it terrifying. These contracts don't trade on open exchanges. They aren't monitored by regulators. They don't have transparent prices. Instead, they are done behind closed doors, bank to bank, fund to fund, government to bank, each one creating a new thread in a giant invisible web that wraps around the entire global economy. Every interest rate you pay, every loan your bank issues, every move the Federal Reserve makes is tied to this web. And as the U.S. economy becomes more unstable with rising rates, exploding debt, and banking stress, those threads start to tighten. That's why experts say derivatives are like dynamite, harmless when untouched, catastrophic when shaken. And right now, the world is shaking harder than ever. To understand how we ended up with a $900 trillion time bomb sitting under the U.S. economy, you have to go back, way back to the 1970s. Inflation was exploding. Oil prices were out of control, and currencies around the world were swinging wildly. Governments were panicking, corporations were desperate, and banks saw an opportunity. They created simple contracts to hedge risk. A farmer could lock in a price for crops. A company could lock in a currency rate. Nothing dramatic, just tools to survive an unpredictable economy. But then Wall Street realized something. These contracts didn't require them to own anything. They could bet on wheat prices without holding wheat. They could bet on interest rates without holding loans. They could bet on currencies without touching a single dollar. It was infinite money created from mathematical models and future predictions. No factories, no labor, just pure financial engineering. By the 1980s, bankers weren't using derivatives to protect against risk. They were using them to chase profits. The more complicated the contracts became, the more money they could make. And behind them, governments were cheering it on. They believed modern finance had finally tamed risk. Then came 1999 and 2000. Deregulation tore down the last walls separating banks, investment firms, and insurance companies. And with the Commodity Futures Modernization Act, the U.S. officially declared derivatives untouchable. No regulation, no oversight, no transparency. It was like giving Wall Street a nuclear reactor and telling them there are no rules. Do whatever you want. By the early 2000s, the derivatives market exploded at a speed no human institution could track. A simple hedging tool had transformed into a monstrous financial organism, growing faster than governments, faster than economies, faster than anyone could imagine. And now, it's far too big to control. To see why this system is so dangerous, you have to understand how derivatives work, not in technical terms, but in simple, human language. Think of a derivative as a bet between two parties. If one side wins, the other loses. If the market moves slightly, billions can shift instantly. And the craziest part? These bets are stacked on top of each other like a tower made of glass. Start with the most common one, interest rate swaps. It's basically a bet on where interest rates will go. Banks, corporations, even governments use them. A small move in interest rates can trigger huge gains or catastrophic losses. And since the U.S. is drowning in debt, these swaps are now directly tied to America's financial survival. Then you have credit default swaps insurance on loans. But here's the twist. You, Dan T., need to own the loan to insure it. Imagine taking out fire insurance on your neighbor's house. Now imagine 10 people doing that. If the house burns down, all 10 get paid. That's how 2008 happened. Next are currency swaps, where institutions bet on exchange rates. When currencies swing even slightly like the yen or euro, the ripple travels through trillions of dollars in hidden contracts. But the most dangerous of all are synthetic derivatives. These aren't based on real assets. They're bets on other bets. A chain of promises, stacked on promises, multiplied across institutions worldwide. One contract depends on another, which depends on another, all linking back into the same fragile system. This is why the market ballooned to $900 trillion. Not because the world has $900 trillion of real value, but because banks can create unlimited layers of these contracts with almost no cash behind them. It's a skyscraper built from paper, and every floor depends on the one below it staying perfectly still. Here's the part that keeps economists awake at night. This entire $900 trillion structure can collapse from a single missed payment. Not a stock market crash, not a recession, just one counterparty, one bank, one hedge fund, one institution failing to honor a derivative contract. Because in the shadow market, everything is connected. If one thread snaps, the entire web starts tearing itself apart. Imagine Bank A owes Bank B billions on an interest rate swap. Bank A misses a payment. Suddenly, Bank B is exposed. They can't cover their side of the contract. So Bank C, which was tied to Bank B, is now exposed to, and Bank D, tied to Bank C. This cascade doesn't take days, it takes seconds. Derivatives are automated. They react instantly. And once the chain reaction begins, no button, no policy, no emergency meeting can stop it. The most dangerous part is that these contracts aren't on open exchanges. They're private agreements hidden in emails, spreadsheets, phone calls, and internal databases. Regulators don't see them. The government doesn't track them. Even banks don't truly know how exposed they are until the detonation begins. It's like everyone is sitting in a room filled with gasoline, but no one knows who's holding the match. And here's the ticking time bomb. U.S. government debt is the backbone of most derivatives. Every interest rate swap, every loan hedge, every mortgage-backed bet is tied to Treasury yields. But for the first time in modern history, America's debt is unstable. Interest rates have shot up at the fastest pace ever recorded. Bond values have fallen by hundreds of billions. Banks are sitting on unrealized losses so large they can't sell anything without risking collapse. If Treasury yields spike unexpectedly, even for a moment, trillions in interest rate swaps instantly flip negative. Banks would owe impossible amounts of money in minutes. Hedging systems would break. Margin calls would explode across global markets. And a single default anywhere on Earth could snap the entire chain. People think the 2008 crisis was caused by bad mortgages. It wasn't. It was the derivatives built on those mortgages. This time, the bet is even larger. It's the entire U.S. bond market. And unlike 2008, the Federal Reserve can't simply print trillions to save everyone. Inflation is already out of control. The safety net is gone. This is why experts warn. The next crisis won't start in the stock market. It will start in the derivatives market. And when it does, the U.S. economy won't have hours to react. It'll have minutes to understand how close we've come before. You need to look at the 2008 financial crisis, not the way the news told it, but what was actually happening behind the scenes. The story wasn't just about bad mortgages or greedy lenders. The real explosion came from the derivatives tied to those mortgages. The hidden contracts stacked hundreds of layers deep across Wall Street. A few thousand homeowners defaulted, and suddenly a $600 billion mortgage problem triggered over $30 trillion in derivative losses. It wasn't the house fires that caused the disaster. It was the gasoline that banks had been pouring around them for years. Lehman Brothers is the perfect example. On paper, it had about $600 billion in assets. But buried beneath those assets were undisclosed swap agreements and synthetic derivatives that multiplied its exposure far beyond what anyone publicly knew. When Lehman collapsed, the shockwaves hit nearly every major bank in the world within minutes. Not because those banks owned Lehman stock, but because they were tied to Lehman through derivatives that were supposed to be safe. Then came AIG. Most people remember it as an insurance company. But behind closed doors, AIG was effectively the world's largest casino for credit default swaps. When the bets went bad, the U.S. government had to inject $182 billion just to stop the entire system from melting down. Not to save AIG, but to save the banks that bet with AIG. Think about that. One insurance company nearly collapsed the global economy because of contracts that weren't even on its balance sheet. And here's the terrifying part. In 2008, the derivatives market was roughly $500 trillion. Today, it's closer to $900 trillion, to $1 quadrillion, almost double. The bets are bigger, the system is more interconnected, and global debt is far higher. In 2008, we had room to cut rates, inject liquidity, and stabilize markets. In 2025, we don't have that luxury. Inflation is high, rates are high, debt is exploding. The tools we used last time simply don't exist anymore. 2008 wasn't the crisis. it was the trailer. The real movie hasn't started yet. If 2008 was a warning shot, then 2025 is the moment the target stops moving. Every pressure point in the global economy, the ones that were manageable decades ago, is now stretched to its breaking limit. And unlike the past, the Federal Reserve can't simply step in and fix everything with cheap money. The world has changed. The risks have multiplied, and the derivatives tied to those risks have quietly grown into a financial minefield. Start with interest rates. From 2022 to 2024, the Fed raised rates at the fastest pace in modern history. That single move, done to fight inflation, sent shockwaves into every derivative contract tied to debt. Banks are now holding over $650 billion in unrealized losses on their bond portfolios. That means if they sell, they go bankrupt instantly, and the shadow market knows it. Then you have U.S. government debt, which has exploded past levels once considered impossible. Every new Treasury issuance triggers trillions of dollars in derivative repricing. When bond yields rise unexpectedly, it's not just investors who get hurt. It's the entire global web of contracts priced off those yields. A small spike can trigger massive obligations instantly. The danger doesn't stop at America's borders. Global markets are synchronized through derivatives. Japan's weak yen, Europe's energy crisis, China's slowing economy, every one of these stresses is connected to trillions in currency swaps, interest rate swaps, and credit derivatives. And for the first time ever, the US dollar is facing real competition. BRICS nations are building parallel financial systems, reducing their reliance on the dollar. Every step away from the dollar forces derivatives tied to dollar-based assets to adjust, often violently. This is why economists warn that 2025 is uniquely dangerous. The system is leveraged, interconnected, and fragile, and every major pressure point is moving at the same time. If one counterparty, anywhere in the chain, fails to pay its obligations, the shock won't stay regional. It will travel through trillions of dollars in contracts like lightning, global, instant, unstoppable. The shadow market has never been bigger, and the world has never been this unstable. Here is the truth no government wants to admit publicly. They can't control the global financial system the way people think they do. They control interest rates, taxes, budgets, regulations, but those are surface-level tools. Beneath all of that lies the real engine, the real power structure, the real force that moves markets, the derivatives market. And the terrifying secret is that no government, no central bank, and no regulatory body truly understands it, let alone controls it. Every time the Federal Reserve speaks about market stability, what they're really trying to do is calm the derivative exposures tied to U.S. debt. When Treasury yields swing suddenly, it's not just bond traders panicking, it's a trillion-dollar network of swaps that instantly start repricing. That's why the Fed reacts so aggressively, not because of inflation alone, but because the shadow market cannot handle instability. Look at the past 2 decades. In 2019, the Fed suddenly pumped hundreds of billions into the repo market overnight. They didn't do it for small banks or consumers. They did it because derivatives linked to short-term lending were on the verge of snapping. In 2020, when the world shut down, the Fed opened emergency dollar swap lines to Europe and Asia, not for humanitarian relief, but because trillions in currency derivatives were about to implode. And in 2023, regional banks collapsed under the weight of rising interest rates. The Fed launched new backstop facilities within hours, not to save the banks, but to prevent the swaps tied to their bond losses from setting off a chain reaction. Every emergency response has the same hidden purpose: protect the shadow market from detonating. Governments won't say this aloud, because admitting it would mean admitting they've lost control. The real financial system isn't run on cash or savings or even debt. It's run on contracts, opaque, private, complex, and worth more than the economies that depend on them. This is the fear every government shares: the realization that the real power no longer belongs to them. It belongs to the market they can't tame. If the $900 trillion shadow market were to break, it wouldn't look like the crashes people imagine. There would be no slow-motion decline, no dramatic countdown, no time for governments to debate a response. A derivatives collapse happens in real time, measured in seconds, not days, and the chain reaction would move so fast that by the time the public realizes something is wrong, the damage would already be irreversible. It would start with something small, maybe a sudden spike in treasury yields, maybe a major corporation missing an interest payment, maybe a foreign bank defaulting on a currency swap. The spark itself doesn't matter. What matters is what the spark touches. Because the moment one derivative contract fails, all connected contracts instantly reprice. Losses cascade. Margin calls explode. Institutions scramble for liquidity that doesn't exist. Within minutes, liquidity evaporates. Banks stop lending, not because they want to, but because their systems freeze. They can't evaluate their exposure, and without knowing who owes what, every institution becomes a potential risk. Credit markets lock, bond trading halts, companies can't roll over their debt, and suddenly the U.S. financial system loses the one thing it needs to function: trust. The stock market would be hit next, not because investors panic, but because trading algorithms detect instability in derivatives and instantly withdraw from risk assets. Circuit breakers might slow the fall, but they can't stop the underlying detonation. As swaps unravel, global banks begin reporting insolvency. Foreign markets tumble, currency exchange lines jam, ATMs and online banking portals start showing temporarily unavailable. And then comes the real blow. Interest rate swaps tied to U.S. Treasuries begin demanding collateral. Trillions in obligations surface at once. Even the Federal Reserve can't print enough to cover every shortfall. The government is forced to choose which institutions survive and which are left to collapse. This is why experts say a derivatives meltdown would be unlike any crisis in history. It wouldn't feel like a recession. It would feel like the world's financial engine shutting off in an instant. The most unsettling part of this entire story is how deeply connected ordinary Americans are to a system they've never even heard of. Most people think derivatives are something only Wall Street elites deal with: complex contracts traded in skyscrapers far away from everyday life. But the truth is, every American with a mortgage, a savings account, a car loan, a credit card, or a retirement plan is directly tied to this shadow market. When you pay your mortgage, the interest rate you're charged is influenced by derivatives. When your bank gives out loans, they hedge that risk with derivatives. When your employer contributes to your 401k, the fund managers use derivatives to stabilize returns. Even life insurance companies rely on derivatives to protect their portfolios. The entire financial system uses these contracts like an invisible skeleton. You never see it, but without it, the whole structure collapses. Most people think their biggest financial risks are job loss, inflation, or rising costs of living. But the real danger is sitting in a place they're never told to look. If derivatives fail, it doesn't just hit banks. It hits pensions, retirement accounts, college funds, small businesses, and the value of the US dollar itself. Ordinary people would wake up to a world where credit is frozen, banks are offline, and prices suddenly jump without warning. This is the irony. The average American thinks Wall Street is a separate world. In reality, Wall Street's riskiest creation is quietly wired into every part of their financial life. And if the shadow market snaps, everyday people will feel the impact long before the experts appear on TV to explain what happened. For years, the world has been told that the greatest threats to the US economy are inflation, recessions, political gridlock, or global conflict. But none of those come close to the threat sitting quietly underneath everything. The $900 trillion shadow market isn't just another financial system, it is the system. A sprawling maze of promises, bets, and obligations so massive that no government can map it, no regulator can tame it, and no institution can untangle it. It holds together only because everyone involved believes everyone else will keep paying. But belief is fragile. Trust breaks quickly. And the day that trust slips even for a moment, the web collapses under its own weight. That's the part nobody is prepared for. There will be no dramatic warning, no official announcement, no moment for politicians to step in. The system won't crumble slowly like past crises. It will snap instantly because it is made of code, algorithms, and contracts, not cash. And if it snaps, the US won't have days or hours to respond. It will have minutes. The scariest truth is also the simplest. The real financial power of the modern world isn't held by nations, presidents, or central banks. It's held by the $900 trillion market, hiding in the shadows. Most people won't hear about it until it's too late. Most won't understand it until the fallout reaches their bank accounts. But by then, the dominoes will already be falling. Because the future of the US economy doesn't depend on the strength of its currency, its stock market, or its politics. It depends on whether a giant, unregulated, invisible market 30 times the size of the American economy can stay balanced just one more day, and someday it won't.